What if the secret to building lasting wealth wasn't about finding the next revolutionary stock, hiring an expensive financial guru, or timing the market perfectly? What if, instead, it was about embracing a philosophy so simple, so logical, and so powerful that it could be followed by anyone, regardless of their financial expertise? In a world overflowing with financial noise, pundits shouting predictions, complex trading strategies promising instant riches, and hidden fees eating away at your hard-earned money, the average person is left feeling confused, overwhelmed, and paralyzed. The core problem this book solves is cutting through that noise. It provides a clear, actionable roadmap to financial independence, liberating you from the stress and complexity that the traditional investment industry thrives on. In today's volatile economic climate, this message of simplicity and discipline isn't just helpful, it's essential for anyone serious about securing their financial future. This wisdom comes from The Bogleheads Guide to Investing by Mel Lindauer, Michael LeBoeuf, and Taylor Larimore. These authors aren't Wall Street titans. They're successful everyday investors who built their wealth by following the common-sense principles of John C. Bogle, the legendary founder of Vanguard. Their credibility comes not from complex algorithms, but from real-world results and a passionate desire to empower the individual investor. Welcome back to Summary in 15 Minutes, where ideas turn into action and books change lives. Let's dive into the powerful lessons from the Bogleheads Guide to Investing. Chapter 1. The Boglehead Philosophy. Keep it simple. Welcome to the heart of the Boglehead Revolution, a principle so profound yet so elegantly simple that it often feels counterintuitive in our complex world. Keep it simple. If there is one lesson that can single-handedly transform your financial destiny, shielding you from anxiety and the most common investment pitfalls, it is this one. The financial industry has spent billions of dollars convincing you that investing is a labyrinth, a complex game of charts, predictions, and secret knowledge that only the high-paid experts on Wall Street can navigate. They want you to believe that your success depends on their guidance, their products, and their constant activity. The Boglehead philosophy exposes this for what it is, a myth. It's a myth designed to generate fees for them, not wealth for you. The truth is that the greatest advantage you have as an individual investor is not a proprietary algorithm or a hotline to a market guru. It is the power to ignore the noise, to sidestep the game entirely, and to embrace a strategy of radical simplicity. This isn't about being lazy or uninformed. It's about being wise. It's about understanding that in the realm of investing, complexity is the enemy of the average person. It adds cost, it invites error, and it fuels the destructive emotions of fear and greed. The Boglehead approach is your shield against this chaos. It's a disciplined, evidence-based framework that turns the tables back in your favor. It's founded on the idea that successful investing is less about what you do and far more about what you don't do. You don't try to pick winning stocks. You don't try to time the market's unpredictable swings. You don't chase past performance. And you certainly don't pay a fortune to an industry that, as a whole, has proven it cannot consistently beat the market. Instead, you adopt a few simple, powerful rules and let the magic of compounding and the engine of capitalism do the heavy lifting for you. Let's break down the foundational pillars of this life-changing philosophy. The first and most crucial pillar is this: own the entire market. Imagine a farmer with a massive field of hay. Hidden somewhere in that giant haystack is a single needle made of solid gold. The Wall Street approach is to hire teams of expensive needle finders. They use sophisticated tools. They analyze the hay. They debate which quadrant of the haystack is most promising, and they charge you a hefty fee for their search. Sometimes they find a small needle. Sometimes they find nothing. Sometimes they charge you even when they fail. The Boglehead, on the other hand, looks at this challenge and comes to a brilliant conclusion. Why spend all that time, money, and energy searching for the needle when you can just buy the entire haystack? By owning the whole thing, you are guaranteed to own the golden needle, along with every other needle, and all the hay, too. This is the perfect analogy for the stock market. The individual stocks are the needles. Some will be golden winners, soaring to incredible heights. Many more will be duds, rusting away into obscurity. The problem is, no one can reliably tell you which will be which ahead of time. The so-called experts who try are playing a loser's game. Studies have shown time and time again that the vast majority of professional, active fund managers, the people who are paid millions to pick stocks, fail to beat the market over the long run. If the full-time professionals can't do it, what makes us think we, as part-time individual investors, can? The solution is to stop playing their game. Instead of trying to pick the winning companies, you simply buy a slice of all the companies. You buy the entire market. How is this possible? Through a revolutionary invention championed by John Bogle himself, the low-cost, broad-market index fund. An index is simply a list of companies that represents a particular segment of the market. The S&P 500, for example, is an index of 500 of the largest U.S. companies. A total stock market index fund, the preferred choice for many Bogleheads, goes even further. It holds thousands of U.S. stocks, large, medium, and small, effectively allowing you to own a piece of the entire U.S. economy. When you buy a share of a total market index fund, you become a part owner in Apple, Google, Amazon, and thousands of other businesses, both big and small. You are betting on the long-term ingenuity, innovation, and growth of the market as a whole. The mathematical logic behind this is undeniable. Think about it. All investors, as a group, own the entire market. Therefore, the combined return of all investors must equal the market's return. However, investing is not free. Investors incur costs, management fees, trading commissions, and taxes. These costs act as a direct drag on returns. Therefore, the average return of all investors, after costs, must be less than the market's return. It is a mathematical certainty. By simply buying a low-cost index fund that mirrors the market, you guarantee yourself the market's return, minus a tiny fee. In doing so, you are mathematically guaranteed to outperform the majority of your fellow investors, including the high-fee professionals, over the long term. You win by refusing to play a game that is rigged against you. And this simple idea of owning the haystack doesn't stop at your country's borders. A true Boglehead understands the importance of global diversification. Just as you wouldn't bet your entire life savings on a single company, you shouldn't bet it all on a single country's economy. By adding a low-cost international stock market index fund to your portfolio, you own a piece of leading companies across Europe, Asia, and other emerging markets. This protects you from country-specific risks and allows you to capture growth wherever it occurs on the globe. This powerful combination, a U.S. total market fund and an international total market fund, gives you ownership in tens of thousands of companies worldwide. It is the ultimate expression of diversification, made possible through two simple, low-cost funds. This brings us to the second pillar of the Boglehead philosophy, which is arguably the most important factor you can control: minimize costs. Imagine you and a friend are setting out on a 40-year journey to a distant destination. You both start with the same car and the same amount of fuel. The only difference is that your car has a tiny, almost imperceptible leak in its fuel tank, dripping away just 1% of your fuel each year. In the first year, you barely notice the difference. After 5 years, it's noticeable but doesn't seem critical. But over 40 years, that tiny leak has drained a massive portion of your fuel, leaving you stranded miles behind your friend, who arrives at the destination with a full tank. This is precisely what investment fees do to your portfolio. A 1% management fee sounds trivial, a small price to pay for expert management. But it is not 1% of your initial investment. It is 1% of your entire balance, year after year after year. This is the tyranny of compounding costs, and it is the single greatest destroyer of long-term wealth. Let's look at the numbers. Suppose you invest 100, and it grows at an average of 7% per year for 30 years. Without any fees, your portfolio would grow to approximately 761. Now, let's introduce a modest-sounding 1% annual fee, typical of many actively managed funds. That fee doesn't just reduce your annual return to 6%. Over 30 years, your portfolio grows to only about 574. That tiny 1% fee didn't just cost you a little bit each year. It devoured nearly 190. Zero of your potential wealth, a quarter of your entire nest egg, gone forever. The Boglehead philosophy teaches you that costs are one of the only things you have direct control over in your investment journey. You cannot control the economy. You cannot control market returns. You cannot control geopolitical events. But you can, absolutely, control how much of your money you hand over to the financial industry. This is why Bogleheads are relentless in their focus on minimizing costs. They exclusively use low-cost index funds, where the expense ratio, the primary annual fee, can be as low as 0.04% or even less. Compare that to the 1% or more charged by active managers. That difference, that gap of 0.96% in our example, is a direct, guaranteed, and immediate boost to your net return, year in and year out. By minimizing costs, you ensure that more of your money stays in your account, compounding for your benefit, not for the benefit of a fund manager. It is the closest thing to a free lunch in investing. The third pillar ties it all together. Simplicity in action. A complex strategy is a fragile strategy. It has too many moving parts, too many points of failure, and is too difficult to stick with when emotions run high. The Boglehead philosophy champions an approach that is not just effective, but also breathtakingly simple to implement and maintain. For most investors, a complete, globally diversified, age-appropriate portfolio can be constructed with just 2 or 3 funds. This is often called a lazy portfolio, and it is one of the most powerful concepts in personal finance. The most common example is the 3-fund portfolio. It consists of a total U.S. stock market index fund, a total international stock market index fund, a total U.S. bond market index fund. That's it. That's the entire portfolio. The 2 stock funds give you your growth engine, owning nearly every public company in the world. The bond fund acts as your stabilizer. Bonds are generally less volatile than stocks and often move in different directions during a crisis. Their role is to reduce the overall volatility of your portfolio and provide a cushion during stock market downturns, preventing you from panicking and selling at the worst possible time. The percentage you allocate to each of these 3 funds is determined by your risk tolerance and your investment timeline, a concept we will explore later called asset allocation. But the structure itself remains brilliantly simple. This simplicity extends to maintenance. The Boglehead strategy is not a set-it-and-forget-it plan, but rather a set-it-and-almost-forget-it plan. You establish your simple portfolio, and then you automate your contributions. With every paycheck, a set amount is automatically invested into your funds, a practice known as dollar-cost averaging. This removes emotion and indecision from the process. You are buying more shares when prices are low and fewer shares when prices are high, without ever having to think about it. You pay yourself first and put your wealth building on autopilot. Once a year, you might take 30 minutes to review your portfolio. If the market's movements have caused your allocation to drift from its target, for example, if a strong stock market has made your stock portion larger than you intended, you rebalance. You sell a little of what has done well and buy a little of what has lagged, returning your portfolio to its original target percentages. This disciplined, unemotional process forces you to sell high and buy low, the exact opposite of what most investors do. And then, you walk away for another year. No daily chart watching, no reading expert forecasts, no stressing over market headlines. The sheer simplicity of the plan is what makes it so robust and so easy to follow. This leads us to the hidden genius of the Boglehead philosophy, its profound behavioral advantage. Investing success is often less about financial acumen and more about emotional discipline. The greatest threat to your long-term returns is not a market crash. It is the person you see in the mirror every morning. It is your own instinct to panic when markets fall and to get greedy when they soar. A simple plan is your best defense against your worst instincts. Picture this. It's the middle of a terrifying market crash. The news is filled with panic. Your portfolio is down 30%. If you own a complex portfolio with 40 different stocks, a dozen niche funds, and a handful of alternative investments, what do? Your mind races with 1,000 questions. Which stocks should I sell? Is my tech fund the problem? Maybe I should have bought more crypto? This complexity creates a breeding ground for panic and bad decisions. You feel an overwhelming urge to do something, and that something is usually selling at the bottom, locking in your losses permanently. Now, imagine you are a Boglehead. You own 3 funds. Your plan is simple. Own the world, keep costs low, and stay the course. When the market crashes, you feel the same fear, but your course of action is clear. There are no complex decisions to make. You know you own the entire market, and you know that markets have always recovered from every crash in history. Your simple plan doesn't require you to be a hero or a genius. It just requires you to do nothing, to stick to the plan. This simplicity short-circuits the panic response. It gives you the clarity and conviction to stay invested, allowing your portfolio to recover and capture the powerful returns that inevitably follow a downturn. Finally, let's address a common criticism. Some people hear this philosophy and think, this sounds so boring. It's just average. They are right. It is boring, and average is exactly what we are aiming for. The goal of a Boglehead is not to find a secret strategy that beats the market. The goal is to capture the return of the market itself, reliably and at the lowest possible cost. The market's average return over the long term is what has built incredible wealth for generations. It has turned small, consistent investments into fortunes. By accepting this average, you are virtually guaranteed to beat the majority of investors, both professional and amateur, who pay a premium for the chance to outperform but, in aggregate, fail. Being a boring investor is a feature, not a bug. It frees up your most valuable assets, your time, your energy, and your peace of mind. Instead of spending your weekends analyzing stock charts, you can spend them with your family, honing a skill, building a business, or simply enjoying your life. The Boglehead philosophy democratizes successful investing. It proves that you don't need a high IQ or a fancy degree to build wealth. You just need to understand a few simple rules, have the discipline to stick with them, and let the beautifully simple, powerful engine of the global market work for you over a lifetime. Chapter 2. Choose your asset allocation wisely. If the Boglehead philosophy of simplicity and low costs is the powerful, reliable engine in your vehicle to wealth, then what we are about to discuss is the steering wheel, the GPS, and the braking system all in one. It is arguably the single most important investment decision you will ever make, dwarfing the impact of picking the right stock or timing the perfect market entry. This is the science and art of asset allocation. At its core, the concept is simple. It's the strategic decision of how you divide your investment portfolio among different major asset categories, primarily the high-octane growth engine of stocks and the stabilizing anchor of bonds. Decades of academic research have confirmed this truth, with one famous study finding that over 90% of your portfolio's long-term return and volatility comes from this single decision, not from the brilliant stock picks you made, not from moving in and out of the market. It comes from the deliberate, thoughtful choice you make, right at the beginning, about how much risk you are going to put in your portfolio. Getting this one decision right is the cornerstone of a successful investment plan. Getting it wrong can lead to devastating consequences, regardless of how low your fees are or how disciplined you are in other areas. Think of it like constructing a skyscraper. To soar to great heights, you need steel beams that reach for the sky, representing the growth potential of stocks. But to withstand the inevitable storms and earthquakes of the market, you need a deep, solid, unshakable foundation of reinforced concrete, representing the stability of bonds. An architect who uses only steel beams will build a tall but dangerously fragile tower that will collapse in the first strong wind. An architect who uses only a foundation will have an incredibly safe structure that never gets more than a few feet off the ground. The genius is in the balance, the specific ratio of steel to concrete. Your asset allocation is your personal architectural blueprint for wealth. It dictates how high your portfolio can potentially grow and how well it can withstand the financial storms that are an inevitable part of the investing journey. To build this blueprint, we must first deeply understand our two primary building materials, stocks and bonds. Let's start with stocks, the engine of growth. When you buy a stock or a share, you are not buying a lottery ticket that flickers on a screen. You are purchasing a small fractional ownership stake in a real, living, breathing business. You become a part owner, entitled to a share of that company's future profits and growth. If the business does well, innovates, expands, and increases its earnings over time, the value of your ownership stake will grow. This is why stocks, as an asset class, have historically been the most powerful wealth creation tool known to humankind. They harness the relentless human drive for progress, innovation, and efficiency. However, this incredible potential for growth comes with a significant price: volatility. The path of the stock market is never a straight line up. It is a jagged, unpredictable, and often stomach-churning journey filled with exhilarating highs and terrifying lows. In the short term, stock prices are driven by news, sentiment, fear, and greed, and can plummet by 20, 30, or even 50%. This is the risk you must accept to earn the high long-term returns. For this reason, Money you need in the short term for a down payment next year or tuition in 2 years should never be invested in stocks. Stocks are a long-term tool. You need a time horizon of at least 5, and ideally 10 or more years, to give yourself enough time to ride out the volatility and allow the long-term growth trend to work in your favor. Now, let's turn to our other essential building material, bonds, the shock absorber. If a stock is ownership, a bond is a loan. When you buy a bond, you are lending money to an entity, typically a corporation or a government. In return for your loan, the entity promises to pay you periodic interest payments over a set term, and then to return your original principal at the end of that term. Their return potential is lower than stocks because their upside is capped. You will only ever get your interest and your principal back. But in exchange for this lower return, you get something incredibly valuable: stability. High-quality government and corporate bonds are the bedrock of a sound portfolio. Their primary role is not to generate spectacular growth, but to act as a diversifier and a cushion when stocks are in freefall. Historically, when the stock market panics and crashes, investors flock to the perceived safety of high-quality bonds, which often causes their value to hold steady or even rise. This stabilizing force does two critical things for you. First, it dampens the overall volatility of your portfolio, which provides the immense psychological benefit of not seeing your entire net worth evaporate overnight. This gives you the emotional fortitude to stick with your plan. Second, it serves as dry powder. During a crash, your bond holdings will likely become an overweight part of your portfolio. The disciplined act of rebalancing will force you to sell some of your stable bonds to buy more stocks at bargain basement prices, a move that can dramatically accelerate your portfolio's recovery. Do not underestimate the power of bonds. They are what allow you to stay in the game when everyone else is running for the exits. So, how do you determine your personal blueprint? Your ideal mix of stocks and bonds? This isn't a one-size-fits-all answer. It's a deeply personal decision that depends on 3 key factors: your ability, your willingness, and your need to take risk. First and foremost is your ability to take risk, which is almost entirely a function of your time horizon. The longer you have until you need the money, the more risk you are able to take. Why? Because you have more time to recover from the inevitable market downturns. A 25-year-old investor saving for retirement in 40 years has a massive ability to take risk. If the market crashes by 50% tomorrow, it's a tragedy on paper, but in reality, it's a blip on their 4-decade journey. They have decades of contributions ahead of them to buy stocks at lower prices and decades for the market to recover and compound. For this investor, an aggressive allocation like 90% stocks and 10% bonds is often appropriate. Their portfolio is built almost entirely of steel beams, designed for maximum vertical growth over a very long period. Contrast that with a 60-year-old who plans to retire in 5 years. Their ability to take risk is much lower. A 50% crash in their portfolio could permanently derail their retirement plans, as they simply don't have the time or the future income to wait for a full recovery. They need to shift their focus from aggressive growth to capital preservation. Their portfolio needs more foundation, a more conservative allocation, perhaps 50% stocks and 50% bonds, or even 40% stocks and 60% bonds, would be far more suitable. Their primary goal is no longer to build the skyscraper, but to protect the one they've already built. A helpful starting point for many investors is a simple rule of thumb, such as 110 minus your age equals your percentage in stocks. Using this guideline, a 30-year-old would hold 80% in stocks, 110, 30, while a 65-year-old would hold 45% in stocks, 110-65. This is not a rigid law, but a sensible starting point that illustrates the concept of a glide path, gradually making your portfolio more conservative as you age. However, your ability to take risk is only half the equation. You must also consider your willingness to take risk, which is your personal, emotional risk tolerance. This is about your stomach, not your timeline. This is arguably where more investors fail. They might be 25 years old and mathematically able to handle a 90% stock portfolio, but if they are psychologically wired to panic at the first sign of trouble, that allocation is a recipe for disaster. You must be brutally honest with yourself. Ask the tough questions. How did I feel during the last market crash? Did I see it as a terrifying loss of my hard-earned money or as a rare buying opportunity? If you check your portfolio daily and feel a knot in your stomach with every small dip, you are likely taking on too much risk for your emotional comfort. This is the crucial sleep at night test. Your asset allocation is only correct if it allows you to sleep soundly through the market's inevitable storms. It is far, far better to adopt a slightly more conservative portfolio that you can stick with for a lifetime than it is to choose a theoretically optimal but aggressive portfolio that you will abandon in a panic, selling everything at the bottom and locking in devastating losses. Remember, the best investment plan is not the one with the highest potential return on paper. It is the one that you can actually adhere to when your emotions are screaming at you to do the opposite. Finally, you should consider your need to take risk. This relates to your specific financial goals. Are you on track for a comfortable retirement, or are you behind? An investor who has saved diligently and is ahead of schedule may not need to stretch for higher returns. They can afford to be more conservative, locking in their gains and reducing volatility. Conversely, an investor who started late might feel a desperate need to take on more risk to catch up. This is a dangerous trap. While your goals are important, they can't override your ability or your willingness to take risk. Taking on a 100% stock portfolio out of desperation when you have a low-risk tolerance is like a non-swimmer jumping into the deep end of the pool hoping to learn on the way down. It rarely ends well. Your goals should inform your savings rate first and your risk level second. Once you have thoughtfully considered these three factors, the next step is to formalize your decision. The Bogleheads advocate for creating a simple written investment policy statement, IPS. This might sound intimidating, but it's nothing more than a one-page document you write for yourself. It is your personal financial constitution. In it, you will clearly state your investment goals, your target asset allocation, e.g., 70% stocks, 30% bonds, the specific low-cost index funds you will use to implement this, and your rule for rebalancing. The purpose of the IPS is profound. You create it during a moment of calm, rational thought. It becomes your anchor in a sea of panic. When the next market crash comes, and it will come, and the pundits are screaming about the end of the world, you don't have to think or react emotionally. You simply pull out your IPS. It is the calm, rational version of you telling the panicked present-day you exactly what to do. Nothing. Stick to the plan. This simple document is one of the most powerful behavioral tools an investor can possess. It pre-commits you to a wise course of action, protecting you from your own worst enemy, yourself. For those who find even this level of decision-making daunting, the investment industry has created a brilliant Boglehead-friendly solution, the Target Date Retirement Fund. This is a single, all-in-one fund that handles asset allocation for you. For example, if you plan to retire around the year 2055, you would buy a Target Date 2055 fund. This single fund holds a diversified mix of U.S. quote-day stocks, international stocks, and bonds, all perfectly allocated for someone with your time horizon. Even better, it automatically manages the glide path for you, gradually and professionally reducing the stock allocation and increasing the bond allocation as you get closer to your 2055 retirement date. For the investor who wants the ultimate in simplicity and hands-off management, a single low-cost target date fund is a fantastic and highly effective choice. Finally, once your asset allocation is set, it requires occasional maintenance through rebalancing. Over time, your portfolio will drift away from its target. If stocks have a fantastic year, your 70-30 portfolio might become a 75-25 portfolio. Rebalancing is the simple act of bringing it back in line. In this case, you would sell 5% of your stock fund and use the proceeds to buy more of your bond fund. This disciplined process imposes a powerful buy low, sell high logic. It forces you to trim your winners after they've run up and to buy more of your lagging assets when they are out of favor. You can do this on a set schedule, like once a year on your birthday, or whenever your allocation drifts by a predetermined amount. For most people, a simple annual checkup is all that is needed. Choosing your asset allocation is the moment you transition from being a passive saver to a deliberate investor. It is the act of taking full conscious control of your financial journey. It's not about predicting the future. It's about building a portfolio so robust, so aligned with your personal situation, that it is prepared to succeed regardless of what the future holds. Chapter 3. The Power of Low-Cost Index Funds. We have established the foundational philosophy of simplicity and the critical importance of choosing a wise asset allocation. Now, we arrive at the tool itself, the specific financial invention that makes this entire elegant strategy possible. This is the story of the low-cost index fund, a creation so profoundly powerful and so fundamentally pro-investor that it represents nothing less than a revolution, a declaration of independence for the common person against the vast, powerful, and often self-serving empire of Wall Street. Before the advent of the index fund, the average investor faced a truly terrible choice. On one hand, you could try to pick individual stocks yourself, a daunting task that requires immense skill, time, and emotional fortitude, a path littered with the financial wreckage of those who tried and failed. On the other hand, you could hand your money over to a professional, an actively managed mutual fund, and pay them a handsome fee to pick the stocks for you. For decades, this was the unquestioned wisdom. You paid the experts to navigate the treacherous market waters on your behalf. But what if the experts, as a group, aren't expert at all? What if their navigation is no better than a coin flip, and the hefty price you pay for their services is the very anchor that guarantees you'll lag behind? This is the broken paradigm that the index fund shattered. An index fund operates on a premise of radical humility and unimpeachable logic. It is, in essence, an unmanaged fund. It has no star manager making brilliant bets. It employs no teams of analysts scouring financial statements for hidden gems. Its sole, simple, and transparent purpose is to do one thing: buy and hold all the stocks or bonds within a specific market index, like the S&P 500 or, even better, the total stock market, and to replicate that index's performance as perfectly as possible at the lowest possible cost. An analogy might help. Imagine your goal is to get the full nutritional value of the world's food supply. The actively managed approach is like hiring a world-famous gourmet chef. This chef promises to travel the globe, hand-selecting only the most exquisite and rare ingredients to create a culinary masterpiece for you. The process is secretive, complex, and incredibly expensive. Sometimes the meal is fantastic, but often it's a disappointment, and the chef's fees are astronomical regardless of the outcome. The index fund approach is like having a scientifically calibrated machine that automatically harvests a perfectly representative sample of all the world's food groups, the grains, the proteins, the vegetables, and combines them into a simple, nourishing, and complete meal. It isn't fancy. It won't win any culinary awards, but it flawlessly delivers the exact, full-spectrum nutritional value you seek every single time at a tiny fraction of the cost of the gourmet chef. In the long run, which approach do you think builds a healthier body? The same is true for your portfolio. The index fund delivers the pure, unadulterated, and powerful return of the market itself. To truly appreciate the genius of the index fund, we must first dissect the deep structural flaws of its rival, active management. The promise of active management is alluring. It's a promise of beating the market, of using skill and insight to outperform the average. The reality, however, is a brutal collision with simple mathematics. The Nobel laureate William F. Sharp explained this with the concept of the zero-sum game. Think of the market as a big pie. All investors, both active and passive, collectively own the entire pie. Before any costs are deducted, the return of the average active investor and the return of the average passive investor must, by definition, be identical. They both equal the return of the market pie itself. But investing isn't free. This is where the game turns decisively against the active player. Active management is expensive. It involves research, trading, marketing, and high salaries for managers. These costs are subtracted directly from the active investor's slice of the pie. The passive index fund investor, on the other hand, has almost negligible costs. So, after you subtract the high costs of active management from one side and the tiny costs of passive management from the other, the outcome is a mathematical certainty. The average active investor must underperform the average passive investor by the precise amount of their additional costs. Trying to beat the market through active management is, for the vast majority, a loser's game. You start with a handicap that is nearly impossible to overcome in the long run. But wait, you might say, what about the star managers? What about the legends we read about who do beat the market? It's true, in any given year, some managers will outperform. Just as in a stadium of 50, 0 people flipping coins, a few will manage to flip heads 10 times in a row. We rush to interview these expert coin flippers, asking for their secrets. But their success is almost entirely a product of random luck, not repeatable skill. The hard data on this is irrefutable. Year after year, the S&P Dow Jones Indices releases a report called SPIVA, which stands for S&P Indices versus Active. The results are a sobering indictment of the active management industry. Over a recent 15-year period, more than 92% of U.S. large-cap active fund managers failed to beat their benchmark, the S&P 500. The numbers are similarly dismal across nearly all other categories, in all countries, over all long-term periods. Choosing an active fund is like paying a premium for a lottery ticket that has a greater than 90% chance of being a loser over the long term. Beyond the impossible odds and high costs, active funds introduce other risks. One is style drift. You might invest in a fund that claims to focus on stable, large U.S. companies. But if the manager is desperate to beat the benchmark, They might start making risky bets on volatile small-cap stocks or obscure international companies, fundamentally changing the nature of your investment without your consent. An index fund, by contrast, is the epitome of predictability. A total stock market index fund will always own the total stock market. It does exactly what it says on the tin: today, tomorrow, and a decade from now. Now, let's flip the coin and examine the built-in, undeniable advantages of the low-cost index fund. First, and most powerfully, is rock-bottom cost. We've touched on this before, but it cannot be overstated. Costs are the single most reliable predictor of future fund performance. The lower the fee, the higher your net return. It's that simple. Let's revisit the corrosive power of fees with a 40-year perspective. Imagine you invest 100 in a low-cost index fund with an expense ratio of 0.04%, assuming a 7% annual market return. Your portfolio grows to a staggering $1.45 million over 40 years. Now, let's put that same 100 in a typical actively managed fund with a 1% expense ratio. That seemingly small difference in fees doesn't just chip away at your returns, it wages a war of attrition on them. After 40 years, your portfolio grows to only about 980. The difference is 470. Nearly $500,000 of your wealth was vaporized, transferred from your pocket to the pocket of the fund company, not because of poor market performance, but simply due to the tyranny of compounding costs. John Bogle famously said, "In investing, you get what you don't pay for." Minimizing costs is the surest and easiest way to maximize your share of the market's return. The second advantage is maximal diversification. A single broad market index fund, such as a total stock market fund, can hold positions in over 30 different companies, large, medium, and small. This gives you a breadth of diversification that is practically impossible for an individual investor or even most active funds to replicate. This isn't just about owning a lot of stocks. It's about systematically eliminating what is known as single stock risk. In the early 2000s, Enron was a Wall Street darling, a blue-chip company in many portfolios. When it collapsed into fraud and bankruptcy, investors who had large, concentrated positions in the company were wiped out. If you were an index fund investor, Enron was just one of thousands of your holdings. Its collapse was a tiny, barely noticeable ripple in your vast, diversified portfolio. The index fund protects you from the idiosyncratic fortunes of any single company, allowing you to bet on the success of the entire economy. The third, and often overlooked, advantage is superior tax efficiency. This is particularly crucial for money invested in a standard, taxable brokerage account. Active fund managers are constantly buying and selling securities, trying to position themselves for the next market move. This high turnover of the portfolio often generates a steady stream of capital gains. Whenever a gain is realized, it is legally required to be distributed to the fund's shareholders, that's you, at the end of the year. You are then responsible for paying taxes on that gain, even if you never sold a single share of the fund yourself. It's a constant tax drag that erodes your returns. Index funds, in stark contrast, are paragons of low turnover. Their strategy is to buy and hold. They typically only sell a stock when it is removed from the underlying index. This passive approach generates far fewer capital gains distributions, meaning less of your money is siphoned off to the tax authorities each year. It allows your investment to compound in a much more tax-efficient manner, a subtle but incredibly powerful advantage over the long term. Finally, We have the advantage of simplicity and transparency. With an index fund, you always know what you own. There is no secret strategy, no black box algorithm. This clarity is essential for maintaining the behavioral discipline to stay the course. When you own a portfolio of actively managed funds and the market tanks, it's easy to lose faith. You might wonder, has my manager lost their touch? Is their strategy broken? This doubt can lead to panic selling. When you own the entire market through a simple index fund, your conviction is clearer. You are not betting on a manager. You are betting on the long-term resilience and growth of capitalism. Your faith is in the system, not in a single person, which makes it a much easier faith to keep during times of crisis. So, how do you choose the right index funds? The Boglehead philosophy advises sticking to the core principles. Avoid the temptation of niche or sector-specific index funds, like a robotics index or a cannabis index. These are not tools of diversification. They are speculative bets on a narrow slice of the market, a form of active management masquerading as passive investing. The goal is to own the entire haystack, not to make a bet on which sliver of hay will grow the fastest. The most effective portfolios are built with the simplest, broadest building blocks. A U.S. total stock market index fund, your ownership stake in the entire U.S. economy. An international total stock market index fund, your ownership stake in thousands of companies across the developed and emerging world. A U.S. total bond market index fund, your stabilizing anchor, providing diversification and downside protection. These funds are available from low-cost providers like Vanguard, Fidelity, and Charles Schwab, and they come in two main structures: traditional mutual funds and exchange, traded funds, ETFs. For the long-term Boglehead investor, the differences are minor. Mutual funds are often easier for automating regular investments, while ETFs can sometimes offer slightly lower costs and greater tax efficiency. The crucial factor is not the wrapper, but what's inside. A broadly diversified index with a razor-thin expense ratio. The low-cost index fund is the ultimate elegant solution. It acknowledges the futility of trying to outsmart the market and instead provides a vehicle for harnessing its full, unadulterated power. It is more than just a product. It is the embodiment of a philosophy that empowers the ordinary person to achieve extraordinary financial results. It is the triumph of the common investor. Chapter 4. Stay the course. Tune out the noise. If you have followed the lessons of the previous chapters, you have done something remarkable. You have built a world-class investment portfolio. You have a clear, simple philosophy. You have a wisely chosen asset allocation tailored to your personal circumstances. You are using the most efficient, low-cost, and diversified tools ever created in the form of index funds. You have, in essence, constructed the perfect, all-weather vessel designed to carry you safely to the shores of your financial goals. But building the ship is only the first half of the journey. Now, you must learn to sail it. And you must learn to sail it through the most violent, chaotic, and psychologically terrifying storms imaginable. This chapter is about the final and most difficult challenge in your investment life. It's about navigating the storm, because the greatest threat to your financial success is not a recession, not a market crash, and not a period of high inflation. The single greatest threat to your portfolio is the person staring back at you in the mirror every morning. The battle from here on out is not fought in the markets. It is fought in the 6 inches between your own ears. The ultimate key to wealth is not financial wizardry, but behavioral discipline. It is the ability to master your own emotions, and to follow one simple, powerful four-word mantra: stay the course. Stay the course means adhering with unwavering discipline to the rational, well-designed investment plan you created during a time of calm. It means trusting the plan, especially, and most critically, when every fiber of your being is screaming at you to abandon ship. It means tuning out the constant deafening cacophony of financial noise that is expertly designed to make you panic, to make you greedy, and to trick you into making catastrophic mistakes. To understand the power of this discipline, consider the ancient Greek myth of Ulysses and the Sirens. Ulysses was a captain who had to sail his ship past an island inhabited by the Sirens, mythical creatures whose enchanting songs were so beautiful that they would lure any sailor to their death, causing them to crash their ships upon the rocks. Ulysses knew he was fallible. He knew that in the heat of the moment, his willpower would fail against their irresistible song. So, what did he do? He made a plan. He ordered his men to fill their own ears with beeswax so they couldn't hear the song, and then he ordered them to tie him, Ulysses, securely to the ship's mast. He gave them one strict command. No matter how much he begged, pleaded, or commanded them to untie him, they were to ignore him and bind him even tighter. As they sailed past the island, Ulysses heard the siren's song. It was as beautiful and as maddening as the legends said. He went insane with desire, thrashing against the ropes and screaming for his men to release him and steer toward the island. But his crew, deaf to the song and obedient to his prior command, simply held their course. They sailed past the island. The song faded, Ulysses' sanity returned, and the ship and its crew were saved. Your written investment policy statement is your command to tie yourself to the mast. Staying the course is the act of trusting those ropes when the market's siren song of fear or greed is driving you mad. To win this battle, you must first identify your enemy. You must learn to recognize the noise so you can consciously tune it out. The noise comes from three primary sources. The first source is the financial media machine. Turn on any financial news channel, and you will be bombarded by a storm of sensationalism. Their business model is not to provide you with sober, long-term financial wisdom. Their business model is to generate ratings and clicks to sell advertising. And they know that fear and greed are what keep eyeballs glued to the screen. Every 5% dip in the market is a crash. Every sustained rise is a bubble about to burst. There is always a breathless expert telling you which stock to buy right now, or which sector to sell immediately. They create a constant sense of urgency, a feeling that you must be active, that you must react to the day's news. This is the polar opposite of a sound, long-term investment strategy. The Bogleheads' first act of defense is to simply turn it off. You are not missing anything. You are protecting yourself from poison. The second source of noise is the endless parade of gurus and market forecasters. These are the well-dressed pundits who confidently stride onto your screen to predict where the market is headed next. Their track record is, to put it mildly, abysmal. In fact, it's statistically no better than random chance. Think about what they are claiming to be able to do. They are claiming to be able to predict the future of a massively complex, adaptive global system with billions of participants, driven by future news that hasn't happened yet, technological innovations that haven't been invented yet, and political events that are unknowable. It's an impossible task. We can barely predict the weather a week from now with any certainty. The idea that someone can predict the Dow Jones Industrial Average a year from now is ludicrous. John Kenneth Galbraith once wryly noted, "There are two kinds of forecasters, those who don't know and those who don't know they don't know. The wise investor does not listen to forecasts. The wise investor builds a portfolio that is robust enough to succeed no matter what the forecast is, because they know the future is, and always will be, uncertain. The third, and by far the most dangerous, source of noise comes from within. Your own destructive emotions. The human brain did not evolve for long-term investing. It evolved for short-term survival on the savannah. We are hardwired with powerful fight-or-flight instincts that served us well when facing a saber-toothed tiger, but which are disastrous when facing a stock market chart. These instincts manifest as two primary emotions: greed and fear. Greed rears its head during roaring bull markets. It's the late 1990s, and everyone you know is quitting their job to day trade, pets.com, and getting rich. It's the feeling of FOMO, the fear of missing out. You look at your sensible, diversified Boglehead portfolio, and it feels boring, slow. You are tempted to abandon your plan, to chase the hot trend, to go all in on that one can't-miss stock your brother-in-law told you about. This urge to chase performance is what causes so many investors to pile into an asset right at the peak of a bubble, just before it spectacularly collapses. But even more powerful than greed is its dark twin, fear. Fear takes over during a market crash. It's 2008. The global financial system seems to be imploding, and your life savings, which you have so diligently accumulated, are down 40% in a matter of months. Every news headline is a prophecy of doom. Your primal survival instinct, the one that tells you to run from pain and danger, is screaming at you to sell, to get out, to stop the bleeding. This overwhelming urge is what causes investors to panic and sell their holdings at the absolute bottom of a market cycle, turning a temporary paper loss into a permanent, catastrophic loss of capital. Giving in to these two emotions is what creates the single greatest sin in investing: buying high out of greed and selling low out of fear. Staying the course is the discipline to do the exact opposite. So, how do we fight back? How do we conquer these powerful external and internal forces? The Boglehead philosophy provides a powerful toolkit for behavioral defense. First, as Ulysses taught us, you must have a written plan. We've discussed the Investment Policy Statement, or IPS. This document is your shield. When you feel the hot emotions of fear or greed rising, your one and only action should be to stop, take a deep breath, and read your IPS. It is the voice of your past, rational self, reminding your present, emotional self of the long-term plan. It reminds you that you planned for this volatility, that market downturns are a normal and expected part of investing, and that your plan is designed to endure them. Second, automate everything. The easiest way to avoid making emotional mistakes is to remove emotions from the process entirely. Set up automatic, recurring investments from your checking account into your portfolio every week, every 2 weeks, or every month. This money gets invested like clockwork, regardless of whether the market is soaring, plunging, or going sideways. This system turns the powerful strategy of dollar-cost averaging into an effortless, mindless habit. You are consistently buying shares without ever having to make a conscious decision, insulating yourself from the temptation to time the market. Third, and this may sound radical, don't look at your portfolio. For a long-term investor, the daily, weekly, and even monthly fluctuations in your account balance are meaningless. They are just noise. Checking your portfolio constantly is like weighing yourself every 5 minutes while on a diet. The small random fluctuations will only drive you crazy and tempt you to abandon your plan. Constant monitoring does not help you. It only serves to amplify your emotional reactions to market volatility. Put yourself on a portfolio diet. Commit to checking your balance no more than once a quarter, or better yet, only once a year, when it's time to rebalance. Let your money compound in peace. As the old investing adage goes, the best performing portfolios are often found in the accounts of people who have forgotten they have them. Fourth, you must understand market history. Knowledge is the ultimate antidote to fear. When you are in the middle of a terrifying crash, it feels unprecedented. It feels like this time is different. It never is. Take the time to study the great market crashes of the past. The Great Depression, the crash of 1987, when the market fell over 22% in a single day, the dot-com bust of 2000, the financial crisis of 2008, the COVID panic of 2020. You will discover two things. First, the market has always every single time recovered and gone on to new all-time highs. And second, every single one of those terrifying moments of maximum pessimism was, in hindsight, a generational buying opportunity for those who had the courage to stay the course and keep investing. When you can view a current crisis through the long lens of history, it loses much of its terror. You see it not as an end, but as a temporary and ultimately survivable part of the process. Finally, you must learn to reframe your thinking. This is a powerful mental shift. If you are a net saver, that is, you are still in your working years and adding new money to your investments, a market crash is not a tragedy. It is a gift. Think about it like a sale at your favorite store. If everything in the store was suddenly marked down 40%, would you run out screaming in terror? Of course not. You would rush in, excited to buy the things you were planning to buy anyway at a massive discount. A stock market crash is a sale on the assets you need to buy for your retirement shares of the world's greatest companies. When the market falls, you are not losing money. Your existing shares are temporarily marked down, but the new money you invest is buying those shares at a wonderful discount. Embracing this mindset transforms fear into opportunity. The legendary investor Benjamin Graham encapsulated this entire mindset in his famous parable of Mr. Market. He asked us to imagine that we are partners in a business with a manic-depressive man named Mr. Market. Every day he comes to your office and offers to either buy your shares or sell you his at a certain price. Some days, Mr. Market is euphoric, and he offers to buy your shares at a ridiculously high price. Other days, he is utterly despondent and terrified, and he offers to sell you his shares at an absurdly low price. Graham's key insight is this: you are under no obligation to trade with him. He is your servant, not your master. A foolish investor allows Mr. Market's moods to dictate their own. They get euphoric when he's euphoric and terrified when he's terrified. A wise investor does the opposite. They ignore him on his good days, and they happily take advantage of his despair, buying from him at a bargain when he is in a panic. Staying the course is the simple wisdom of ignoring Mr. Market's daily mood swings and sticking to your own long-term business plan. After all the research, all the strategy, and all the planning, the secret to investment success is almost laughably simple. Once you have a sound plan, do almost nothing. Your discipline to stay the course, to tune out the noise, and to let your simple, low-cost portfolio do its work over a lifetime will be the ultimate determinant of your success. It is not an easy path. It requires patience, conviction, and courage. But it is the only path that truly works. Chapter 5. Minimizing taxes and fees. In our journey so far, we have focused on the grand, powerful forces of wealth creation, developing a sound philosophy, choosing a strategic asset allocation, and harnessing the growth of the global markets through low-cost index funds. These are the elements that propel your portfolio forward. But a successful journey is not just about the engine that drives you. It's also about eliminating the hidden forces that are constantly trying to hold you back. There are two such forces, two silent partners in your investment accounts who have their hands perpetually outstretched, ready to skim a portion of your hard-earned growth. Their names are fees and taxes. Unlike the unpredictable gyrations of the market, fees and taxes are two of the most significant variables that you, the investor, have almost complete control over. Mastering them is not the most glamorous part of investing. It lacks the thrill of picking a winning stock or the drama of a market rally. But it is among the most impactful. Think of your investment journey as a marathon. The market's return is the talent and conditioning you bring to the race. But fees and taxes are weights you are forced to carry. The active investor, paying high fees and ignoring tax strategy, is running the marathon with a heavy backpack and ankle weights. The Boglehead, by relentlessly minimizing these costs, is shedding every single ounce of unnecessary weight, allowing them to run faster and further with the exact same effort. This chapter is about becoming a ruthlessly efficient investor. It's about ensuring that the lion's share of the money your portfolio earns stays where it belongs, with you. Let's begin by declaring an all-out war on fees. We've discussed their corrosive power before, but their importance is so monumental that it demands a more focused, tactical examination. If you take only one action after listening to this, it should be to conduct a thorough audit of every single fee you are currently paying. The most obvious and persistent enemy is the expense ratio. This is the annual percentage fee that every mutual fund and ETF charges to cover its operating costs. It is deducted automatically and silently from your returns. Your first mission is to become a fee detective. Log into your 401k, your IRA, and any other investment accounts you hold. For every single fund, find the expense ratio. It might be listed as a percentage, like 0.75%, or in basis points, like 75 BPS. Write it down. Now, compare your findings to the Boglehead standard. Any fund with an expense ratio below 0.2% is generally acceptable. Any fund approaching 0.5% should be viewed with extreme skepticism and have a very good reason to exist in your portfolio. And any fund charging close to 1% or more is a serious problem. It is a leak in your financial boat that, over a lifetime, will sink your prospects. Replacing a single high-cost fund with a nearly identical low-cost alternative is one of the easiest and most impactful financial decisions you can make, offering a direct, guaranteed boost to your net return for decades to come. But the expense ratio is just the tip of the iceberg. The financial industry has devised a whole host of other, more cleverly hidden fees designed to separate you from your money. You need to watch out for loads, a quaint term for what is simply a sales commission. A front-end load is a percentage of your money taken right off the top the moment you invest. A 5% front-end load means that if you invest 10 only, 950 actually goes to work for you. A back-end load or contingent deferred sales charge is a fee you pay if you sell the fund within a certain number of years. In the Boglehead universe, there is a simple, ironclad rule. You should never, ever pay a load. With countless high-quality, no-load index funds available, paying a sales commission is completely unnecessary. The final, and perhaps most devastating fee, is the advisory fee, specifically one charged as a percentage of your assets under management, or AUM. This is the model used by many traditional financial advisors. They manage your portfolio for you, in exchange for an annual fee, typically around 1% of your total account balance. This fee is layered on top of the expense ratios of the funds in your portfolio. Let's be very clear about the math here. A 1% AUM fee does not sound like much, but its long-term impact is catastrophic. Imagine you have a 500 portfolio. A 1% fee is 50 that year. But as your portfolio grows to 1 million, that same 1% fee is now 10 per year. Over a 30-year period, this single fee can consume a third or even more of your potential nest egg. It is a relentless headwind that makes achieving your financial goals exponentially harder. A Boglehead investor aims to become self-sufficient by following the simple principles of this philosophy. If you do need advice, seek out a fee-only financial planner who charges a flat or hourly rate for their time, rather than entering into a long-term AUM arrangement that siphons off a percentage of your wealth every single year. Once you have minimized your fees to the bare bones, you can turn your attention to the second silent partner, taxes. The goal here is not tax evasion, but smart, legal tax avoidance. It's about structuring your investments in such a way that you pay the absolute legal minimum in taxes on your growth. A dollar saved from taxes is just as valuable as a dollar earned in the market. As the old saying goes, it's not what you make, it's what you keep. The first and most powerful pillar of tax efficiency is to utilize tax-advantaged accounts to the absolute fullest. These are retirement accounts, like 401ks and IRAs, that the government has created to incentivize saving. They are, without question, the best deal in town. These accounts come in two main flavors. First are tax-deferred accounts, like a traditional 401k or a traditional IRA. The magic here happens up front. The money you contribute is pre-tax, meaning it's deducted from your paycheck before income taxes are calculated. This directly lowers your taxable income for the year, resulting in an immediate tax saving. Inside the account, your investments grow tax-deferred. This means that as your funds generate dividends or capital gains, you pay no taxes on them year after year. This allows your money to compound without the annual drag of taxes. You only pay income tax when you withdraw the money in retirement. The second flavor is tax-exempt, represented by the Roth 401k and the Roth IRA. The Roth is, for many, the holy grail of investing. You contribute with after-tax dollars, so you don't get an immediate tax break today, but its power is on the back end. Once inside the Roth, your money grows completely, 100% tax-free. And when you withdraw it in retirement, it is completely 100% tax-free, no matter how large the account grows to 1 million, 2 million, or more. You will never pay another dime of tax on that money. Given these powerful tools, a wise investor follows a clear order of operations. First, if your employer offers a 401k with a matching contribution, you must contribute enough to get the full match. This is an instant, guaranteed 50% or 100% return on your money. It is free money. There is no better investment on the planet. Second, you should aim to fully fund a Roth IRA if you are eligible based on your income. Third, if you still have money to invest, go back to your 401 and contribute as much as you can, up to the annual legal limit. Only after you have completely maxed out all of this available tax-advantaged space should you begin investing in a standard taxable brokerage account. This leads us to the second pillar of tax efficiency, a more advanced but crucial concept known as asset location. This is not the same as asset allocation. Asset allocation is about what percentage of stocks and bonds you own. Asset location is about where you choose to hold those assets. The guiding principle is simple. You should hold your most tax-inefficient investments inside your most tax-efficient accounts, your 401ks and IRAs. Which investments are tax-inefficient? Primarily bonds. Bonds generate regular interest payments, which are taxed at your high ordinary income tax rate. If held in a taxable account, this interest income would create a significant tax bill each year. Therefore, your bond funds should, whenever possible, be held inside your tax-deferred or tax-free retirement accounts, where their interest payments are shielded from this annual tax drag. Which investments are tax-efficient? Broad market stock index funds. As we've learned, they have low turnover, which means they generate very few capital gains distributions. And the dividends they do pay out are often qualified dividends, which are taxed at a much lower rate than ordinary income. Because these funds are already naturally tax-friendly, they are the best candidates to hold in your taxable brokerage account if you have one. Think of it like packing a suitcase for a trip in the rain. You put your sensitive electronics and clothes, your tax-inefficient bonds inside your waterproof suitcase, which is your IRA. Your raincoat, your tax-efficient stock fund, is already waterproof, so it's fine to have it on the outside in your taxable account. This strategic placement of assets can save you thousands in taxes over your lifetime. Finally, even within your taxable account, you can employ smart strategies. The most powerful is simply to buy and hold. The tax code is designed to reward long-term investors. As long as you don't sell your appreciating assets, you don't realize a gain, and you don't owe any tax. You can let your stock index funds compound for decades without paying a single cent of capital gains tax. The second strategy, for more advanced investors, is tax loss harvesting. During a market downturn, you can sell an investment in your taxable account that is at a loss. This realizes the loss, which can then be used to offset capital gains elsewhere in your portfolio, or even up to 3/0 of your ordinary income. You then immediately reinvest the money into a similar, but not identical fund to maintain your market exposure. This allows you to turn a temporary market decline into a tangible tax saving. Mastering fees and taxes is the final frontier of portfolio optimization. It's the art of efficiency. Every dollar you save is a dollar that remains invested, working and compounding on your behalf. These savings are not speculative. They are as close to a guaranteed return as you will ever find. By waging a relentless war on costs, you become the master of your own financial destiny, ensuring that the wealth you build is truly your own. Chapter 7. Conclusion. We have reached the end of our summary, but we have also arrived at a powerful new beginning for you. Think back to where we started, standing in the middle of the dense, noisy jungle of the modern financial world, a place of confusion, filled with the conflicting shouts of self-proclaimed gurus, the flashing lights of market predictions, and the hidden traps of high fees and complex products. The path forward was unclear, and the journey seemed reserved only for the wealthy or the brilliant. But now you have a map. You have a compass. You have emerged from that jungle onto a clear, straight, and simple path that leads directly to your destination. You now possess the complete, time-tested philosophy that has allowed countless ordinary people to achieve extraordinary financial success. Let us, for one final time, assemble these powerful lessons into a single, cohesive creed. It all begins with the revolutionary idea to keep it simple. You have learned that simplicity is not a shortcut. It is a profound strategic advantage. It is your shield against the high costs, the needless complexity, and the emotional errors that plague the vast majority of investors. You now know that the single most important driver of your long-term results is your decision to choose your asset allocation wisely. This is your personal blueprint for wealth, the deliberate balance of stocks and bonds that aligns your portfolio with your own timeline, temperament, and goals. It is the foundation upon which your entire financial future is built. You have been given the tool to execute this plan, the elegant and powerful low-cost index fund. You understand now that trying to beat the market is a loser's game. The true path to victory lies in owning the entire market, capturing its full wealth-generating return at the lowest possible cost, thereby guaranteeing your outperformance over the majority of high-fee active players. You have been armed with the most crucial piece of wisdom for navigating the journey, the discipline to stay the course. This is the ultimate test of an investor's character. It is the courage to tune out the terrifying noise of market crashes and the siren song of speculative bubbles, and to adhere to your rational plan when your emotions are in turmoil. It is the simple, powerful act of doing nothing when everyone else is panicking. And finally, you have learned to optimize your journey by minimizing taxes and fees. You now see these costs not as minor annoyances, but as relentless headwinds. By waging a war on every unnecessary fee, and by intelligently structuring your accounts to be as tax efficient as possible, you ensure that more of your money stays working for you, compounding for your future, not for Wall Street or the tax collector. But the Boglehead philosophy is more than just an investment strategy. It is a life strategy. It teaches you to focus on what you can control and to accept what you cannot. It champions a long-term perspective over short-term gratification. It proves that discipline, patience, and consistency will always triumph over frantic, emotional reactions. It is a message of empowerment, a declaration that you, the individual, have all the tools you need to take control of your destiny. You do not need to be a genius. You do not need to be wealthy to start. You do not need to predict the future. All you need is a sensible plan, the one you now hold in your hands, and the discipline to follow it through the years. So let this be your call to action. Knowledge without action is merely entertainment. The true purpose of our time together is to spark a change. So I urge you, do not let this moment pass. Take one small, concrete step today, right now. Maybe it's logging into your 401k to finally check your expense ratios. Maybe it's opening a Roth IRA. Maybe it's taking out a piece of paper and writing the first sentence of your investment policy statement. The journey to $1 million and beyond does not begin with a giant leap. It begins with a single, humble step, followed by another and another. The most important step is the first one. Take it now. The simple, elegant path to wealth is right in front of you. The power to build a future of freedom, security, and peace of mind is and always has been in your hands.